Good morning and welcome to this Wednesday, August 12th, 2020 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we've got a couple things going on here in the market this week for sure. Inflationary numbers coming out much higher than expected. We saw the PPI yesterday out higher than expected. This morning it's the CPI. Both the headline number and the core number. So part of the reaction that we're seeing in the bond market with yields rising has to do with potentially higher inflation, also potentially a stronger economy. And we're seeing that through the transports breaking up. We're going to get into some of that in just a bit. I do want to first point you, especially if you're new, over to our EarningsBeats.com site. And if you go in here to our home page, you can sign up for our free EarningsBeats Digest newsletter. Comes out Mondays, Wednesdays, and Fridays. I can tell you that today I actually did something a little different and looked at the transports and also the 10-year Treasury yield and wanted to kind of show you a correlation between the two, which I think is really interesting. So make sure you check that out. And if you're not an EarningsBeats Digest subscriber, there's no credit card required. Simply put your name and email in here, hit subscribe. You'll join the thousands of folks around the globe that are receiving this 3 times a week. And I think there's some great information in there, educational, sometimes some solid trading opportunities. But I think you'll enjoy it. If not, just simply unsubscribe. It's pretty simple. If you unsubscribe, you'll be removed. No big deal. Also, I wanted to just point out that if you go over to YouTube, also put this in the, go into stock charts. There we go. Your daily 5. So if you go into stock charts, your daily 5 and go down, that's the old one, I think. Yeah, right here, following the strength. So just go in, you can type in stockcharts.com, your daily 5. It's a daily show that they have, and they have different guests come on and give 5 charts that they're watching. Transports was one of the charts that I pointed out. Actually, it was the first one. So make sure you go over and check this video out. Really appreciate it. And check those, the Stock Charts YouTube channel out, along with EarningsBeats YouTube channel. A lot of great information in there for sure. All right, let's move on and get things started here. As far as the action goes on, or went on Tuesday, you can see the Dow Jones Industrial Average, big reversal. We were up into breakout territory. I think at one point when I sent out the daily market report, we were up probably 300 points on the Dow. Ended up finishing down 100, so obviously there's a big reversal in the afternoon. Futures right back up again, though, this morning. I don't know. It's very difficult to bet against this market, but right now in pre-market, the Dow showing up 292 points. So a lot of that afternoon selling coming right back today. The S&P 500 also with the reversal down 27 points, which is actually 4/5 of 1%, 0.8 of 1%, depending on how you look at it. NASDAQ down 1.69%, though, once again lagging. We've been seeing this recently. I'm not surprised. Actually, again, I'll say that not that I'm pleased because I trade more on the NASDAQ side, but it actually adds to my bullish case to see some of these other areas of the market breaking out that had been lagging for so long. It's actually bullish for everybody to see this wide participation. Mid caps fell slightly. Small caps, same thing. But again, they were up nicely earlier in the day and just gave it up in the last couple hours. Financials led yesterday. Industrials. We'll talk about this a little bit during today's show, but financials rose more than 1%. Industrials over 0.5%. Those were the only 2 groups that held on to their gains and finished in positive territory on Tuesday. You can see the laggards: utilities, real estate, and technology. Now, with that selling yesterday, if everything was horrible, you would have seen the sellers, the big sellers, the big laggards, instead of being utilities and real estate, which is more defensive groups, you would have seen more, not just technology, but you would have seen communication services, consumer discretionary, those types of stocks leading. And it wouldn't have been for one day. It would have been for 3 weeks. So that's the type of thing I'd be looking for if you're bearish. You want to see some of those aggressive groups selling off hard for a period of time. We haven't really seen that. You can see technology down the last couple of days, but still clearly in this uptrend. So the breakdown yesterday was interesting, financials and industrials gaining. But when you think about it, you know, the 10-year treasury yield, I'll show you this right here, 10-year treasury yield yesterday, look at this move to the upside. I kept saying I wanted to see that move above the 20-day moving average. It had been a while. Well, we got it in a big way yesterday, and we're continuing that to the upside. Again, there's a couple of reasons why 10-year treasury yield would rise like this. One is inflationary pressure, and the other is a stronger economy. Now, we can argue which reason that the 10-year treasury yield's going up. Obviously, we've had some inflationary reports the last couple of days, so that has aided the move to the upside. But I believe the economy is strengthening too. Inflation alone wouldn't send the transports higher, and the transports I'm going to get into in a minute. But let me just make sure I got the latest here. Right now, 0.686, so 0.69 rounded, and that's up. We're up almost 3 basis points today after being up 8 basis points yesterday. That's a huge move, and it's not just a number. You have to realize that when the treasury yield is moving like this to the upside, it means there's a lot of selling going on in treasuries. Now, if the stock market were not the place to be, all that selling in treasuries and the yield going up, you know, the stock market would go nowhere. But we saw financials and industrials being bid up pretty hard yesterday, and even many of the other groups were up as well until the last 2 hours of the day. But I think we're going to see another day of equity gains today, at least at the open early on, and I certainly expect financials and industrials to continue to do well. So let's move over into talking technically. What I want to talk about is transports. Now, yesterday's candle, it's going to be interesting to see whether or not we can take out yesterday's high. I believe we will. Technically, this isn't a key area for the transports. We've gone straight up. It wouldn't be a bad thing if we were to consolidate for a bit, but you can see there was one, that's the bottom of this gap, but right here is the top of this gap. And if you notice, that was where we tried to break through and then failed late in the day. So we could have seen a little bit of technical sellers in transports, and this was a group that's been leading the market. If you look at August, even back into July, but especially August, this is where we really turned up. We took out the June high, and this right here, this move up in August has coincided, if you look at the 10-year treasury yield, with this move up in treasuries. So you can sit back and argue that, hey, this is inflation, this has nothing to do with the economy, but the transports, the way the transports are trading would tell you otherwise. So I think that this is a combination. I think the inflationary reports are adding to the selling in treasuries, but I believe it has more to do with the market looking out and saying, you know what, economy's looking better. This is going to benefit transports eventually. Truckers were already doing well. Airlines were okay, not exactly great, and airlines were horrible. But all of those areas are doing better with the transports rising like this. So overall, pretty good action. So with the transports doing well, they're part of industrials. So I thought I would look at the industrials here, show you this on a relative basis. So this is I keep the sectors on a relative strength, in a relative strength chart list. And the XLI right here versus the S&P 500, trying to move to about a 5-month high. And I think we might get that break today. Now, is it an all clear sign? No. And I'm still not sure. I mean, the Fed has told us interest rates going to remain low for the next couple of years. And if that's the case, transports can do well. I just don't know that they're going to be the leaders going forward. I think they're playing catch up right now. That's a difference. You know, money rotating temporarily is completely different than showing, you know, massive strength down the road. So I think that what we're going to see is money continue to rotate in the near term. I want to watch the ratios. I pointed this out in the DMR yesterday, but we could take a look at the IWF, IWD. I think this is going to be a key ratio to continue to watch. As long as this consolidates or even breaks down to the downside, then I think it's all clear for transports, industrials, financials to the upside. But if we see this reverse back and start moving back to the upside, I think some of that relative strength in the transports probably is over, because transports aren't really growth stocks. They're more cyclical stocks. And so as the market anticipates economic growth, we'll see the transports do well. But if interest rates remain low, there's no doubt in my mind money is going to rotate into those areas that can really produce major earnings growth. And that would be many of your technology areas, communication services, especially the internet, and then also many of the consumer discretionary areas, some of the online retailers, the broadline retail, specialty retail, some of those areas should continue to do well in a low interest rate environment. And let's not lose sight of this. I mean, yeah, 10-year treasury yield jumping, but it's not like we're talking about a 5% 10-year treasury yield. We're still down below 0.7%. If we go back and look at this on a monthly basis, let's go back 50 years. I mean, the 10-year treasury yield, look at where we are. I mean, if we bounce back up to 2 or 3%, that's still low by historical standards. So don't get spooked. I mean, that'll be the next thing. You know, treasury yields are rising. Now we got an interest rate problem. We don't have any kind of an interest rate problem. If the economy's strong, we can handle interest rates 2 or 3, maybe even 4%. I wouldn't worry about it. But this money moving, this yield moving up, what this is going to do is create billions of dollars rotating out of the bond market. That money isn't going to go into a money market fund, I can promise you. If the economy's strong and earnings are growing, it is going to come over and it's going to help fuel a massive rally in equities. So I'd be real careful about listening to anybody who talks about, well, interest rates are rising, we're in trouble now. We got lots of room to the upside. I would not worry about that. In fact, I think this whole drop here with the pandemic and all, with the pandemic and all, I think, you know, we're in this long-term downtrend here, but I think getting back up to 1.5%, 2% is very doable in the next year or two. And that's still rates being low for the next couple of years. May not be at zero, but it's still very low. So I expect this downtrend to remain in play. All right. So we talked about the transports, talked about the XLI and the IWF versus IWD. Very important to watch this. And I'm going to change this over to a line chart. Because also, in addition to this, another ratio that we can certainly watch is the NASDAQ 100 versus the Dow Jones. And if you look we're getting the same type of ratio or same type of chart. They set up almost identically. I mean, if I didn't show you the titles, you wouldn't be able to probably tell the difference between these two charts. Okay. So this brings me to industrials and financials, because if we are still going to see short-term, the 10-year treasury yield rise, then we absolutely could see outperformance in these two areas. Until these ratios that I just showed you, NASDAQ versus the Dow and IWF versus IWD, until you see that start to turn back up again, and I'm going to go back here to this one, and let me just type this back in here again. Because one of the things I sent out to the members yesterday was an intraday. Let's do a 1 hour. Don't really need the volume. Don't need that, but let's go. Let's look at the last 6 months. And when you look at this, you see the downtrend here over the past, I don't know, few days. But really, we've had no strength in growth versus value since the beginning of the month. That's coincided with this big move in transports to the upside. Now, are we going to turn? I mean, we got some pretty key relative support that we're about to hit. And I mean, last time we went down for a period of time, remember when we got that June move up in the 10-year treasury yield? Now, let me go back to that one day daily chart. See this move here in the 10-year treasury yield, how we bottomed here in mid-May and ran up to early June? Well, if we go in here, that's where we had growth, not in favor any longer. Value is in favor. So the growth, this relative strength line of growth versus value dipped while that yield was rising. Well, now we got the yield rising again. See what's happening? It's the same thing. This is, I mean, it's just rotation. But what's the long term look like? I think you can see what the long term looks like. And if we go to, if we go to a weekly chart and go out 5 years, I mean, what's the, can you see what's going on here? Rates have been coming down. For the most part, the economy was very strong until the pandemic hit. We had a little bit of a crisis here in fourth quarter of 2018. If you recall, that was the trade war. But, for the most part, we've been going higher. And with rates low and earnings continuing to increase, I just think this is the focus. I think this is what we need to focus on. Now, we've gone up a lot. Could we pull back some more? Absolutely. And that's why I'd go back to that short-term support level on that hourly chart that I just showed you and take a look at that support area right in here. Because if this breaks, then I think that transport trade, the industrial trade, the financial trade could definitely last longer. This will be an important chart to watch for that. Okay, so next up. So we know industrials are doing well. We know financials are doing well. How can we, what can we do to take advantage of this? Well, I wrote a scan, and this scan is very simple. What I did is I just said, okay, I'm looking for improving stocks within the industrial sector, okay? And so what I said was, okay, Scooter is greater than 80, and 5 days ago, the Scooter was less than 70. So all I'm doing is I'm looking for the Scooter, which is the stock chart's technical rank. This is a relative strength indicator, and I want to see which stocks within the industrials are beginning to show additional relative strength. And then I picked the group as the industrial sector. So I'm really just narrowing in on this very simple scan, but definitely can give us some good results. I'll check syntax, just make sure I'm good there, and then we'll run this scan. All right, I got 15 stocks on this list. Remember, Scooters were below 70 5 days ago. Now they're above 80, and some of these you can see have gone up in the 90s. We can sort this. So power, or Quanta Services, PWR, in heavy construction has gone to 97.4. That's pretty rapid. So this is definitely a stock I'd be interested in at least doing a little bit more research on. Pull up Quanta Services and check this out. Not only are we seeing this Scooter go up into the upper 90s, but this stock broke out of a sideways consolidation pattern. We had been sideways consolidating, struggling to get through 44 for a long time. Look at the volume coming in. Look at the accumulation distribution turn up. PPO off the center line pointing higher. Now, this one's been up for 5 or 6 days. Like to see a pullback. The rising 20-day moving average and price support at 44, rising 20-day moving average is down at 42.77. Now, it might not come down first to that level. It may not come down that far. So one thing you could look at is something like the 20-hour EMA for a trade. So PWR, if you're looking here, that's at 48. So it's been rising and staying above the 20-hour EMA. So if you're like, okay, I don't know if it's going to come back down to 44, it probably will at some point. But in the near term, I would expect the rising 20-hour EMA to hold. So in other words, if it comes back down, similar to this, except we didn't quite get down to the 20-hour, but I'd wait for a little bit of a pullback, try to get closer to the 20-hour, and then you could set a closing stop or maybe an intraday stop a little bit below that rising 20-hour. And then look for another move. And what you might see is a bounce off the 20, another move to a high, and when you get that high, you might have a negative divergence on the hourly. And if that happens, then you look for the 50-hour test, which is down below 45, which also isn't too far from this area of support I'm talking about. So that's how a lot of times charts, and stocks will develop. They'll pull back, but they won't go all the way back to the 20. They'll test maybe the 20-hour EMA, not the 20-day EMA, bounce, put in a negative divergence on the hourly chart, and then pull back on the daily chart a little bit further to that 20-day. And by that point, the 20-day is going to maybe be up at 45, maybe even higher than that, who knows. So anyway, that's one stock on this list, PWR. Another one, Altra Holdings, AIMC. Pull this one up. Once again, sideways consolidation. Many of these industrial stocks have not been like technology stocks. They haven't made that breakout. They're starting to play catch up. And that's, in my opinion, that's what this whole rally is about. It's not that transports or these value stocks are better than growth stocks. I don't believe that. I think growth stocks in a low interest rate environment with economic improvement ahead, I think growth stocks are going to continue to outperform. But in the short term, absolutely, I expect we're going to see some outperformance as long as the transports are rising, as long as that IWF versus IWD is going down. I think we'll continue to see financials and industrials leading. Let's see, what else do we have here? Another industrial machinery. Here's commercial vehicles. I wanted to get into a different group. So we talked about heavy construction, industrial machinery, commercial vehicles. Pull this one up. This one doesn't look as good to me. I mean, it's trending above its 20-day, looks fine, but it's way below where it was back in November. And this was actually falling in January and February when the economy was strong. So it's got a little bit more work to do. Let's see if there's anything else. Building materials, Owens Corning. This one's right up against resistance. Maybe it gets that breakout today. AD line looks pretty nice. PPO rising. This one doesn't look bad. But these, again, these are just stocks that show us which ones are gaining strength relative to their scooter peers. And when I say scooter peers, it's large caps versus large caps. It's not industrial machinery versus industrial machinery like it would be AIMC. It's going to be mid caps. How is it doing versus other mid caps? Well, there's a lot of mid cap technology stocks that it's being compared to, which have been doing really well. So to get up into that zone, you've got to be doing pretty darn well. So that's why PWR and AIMC breaking out of those sideways consolidations are being treated better on a scooter score ranking system than, say, Owens Corning. Now, when you look at these industries, that's one other thing that I would maybe be paying attention to is, let me go into relative strength, looking at the industry groups. And now I'm going to go down to where I have all of the industrials. And this is a chart list that we send out to our annual members at EarningsBeats. So you can then, all right, you got a lot of this information. You know, industrials maybe is a place you might want to look in the near term. We know some of those individual stocks in different industries within the industrials are looking pretty good. This is simply going in to look at the industrial group, the industry groups within industrials, and seeing which groups we maybe trust the most. And so right now, waste and disposal definitely has increased since the beginning of July. You know, we've got this little cross, but we're still way deep in negative territory. Truckers to me look pretty strong. So truckers, but they probably already have some of their stocks up above, you know, they were probably above 70, many of them. On that scan that I ran where the industrials 5 days ago have to be below 70, many of the truckers probably are above that. That's why we're not seeing truckers on that list. Same goes with business support services. In diversified industrial, starting to strengthen, but still got some more work to do. Specifically wanting to look at some of these areas that we just talked about. So here's heavy construction. Now, heavy construction's moved back above its 20. That's a pretty good move. Got a little bit of overhead resistance here. Notice that's also the relative bottom here becomes the relative top here. And then you've got the 50. So I think we've got a little bit more room and we're definitely strengthening. But the way I look at this PPO is that its relative momentum had been very weak, and that weak relative momentum is slowing. That's different than relative momentum that's accelerating. When you're above the zero line and moving higher, your relative momentum is accelerating. When you're below the zero line and your line is moving up, your relative weakness is slowing. It's a big difference. And I see a lot of people that like to trade stocks because the PPO is moving up from underneath the center line. Just remember, that just tells you that your relative momentum to the downside, your relative weakness is slowing. That's different than your relative momentum accelerating. You don't really start to show good relative momentum until you get above zero on the PPO. Anyway, so that's heavy construction. Let's see what else we've got here. Industrial machinery. Now, this one looks a little bit better to me. So when I would go in and look at the scan results, industrial, like the AIMC, you know, when I'm looking at the industrial machinery group breaking above the 50, breaking above that June high on a relative basis, look at the PPO, just relative PPO getting ready to go above zero. This is how I would evaluate the groups. You're free to do it however you want, but you know, I like to put all these things together. And when I see industrial machinery starting to strengthen relative to the S&P, and it's at the highest level it's been versus the S&P since back at the end of February, with its relative PPO looking to go positive, that gives me a little bit better feeling for the stocks on this list that are in that group. So I would go in with a slightly more bullish mindset when I'm looking at these stocks in industrial machinery. Let's see, what else did we have here on this list? I know there was aerospace. See, aerospace is still pretty weak. Its strength, you know, its relative weakness is slowing, but it's definitely not a group that I trust. I mean, look what happened if I had, you know, gone in on this move to the upside as it was starting to the weakness was decelerating here. But look at what happened. It accelerated again. Look at this move. Same thing. When we start making more consistent breakouts where we're taking out previous tops and we're moving to 6-month highs and the relative PPO is, you know, about to cross zero, to me, that's much different than what we're seeing on this chart. All right, I think we've gone over this enough. I wanted to go over a couple other things and get wrap this thing up. So let's do talk about a couple of stocks that reported earnings. One in particular that I wanted to go over, which is K12. This is a company that I actually talked about, I don't know, it was back in here sometime when I had a webinar with Grayson. And I liked LRN, K12. I thought there were a couple things that looked really good to me. Number one, back during the pandemic, you can see we quickly moved to a new high on the accumulation distribution even before we got a breakout in price. And we've continued moving higher. And then we got all of this going on. I don't, again, remember exactly when I talked about LRN. It might have been upper 20s, low 30s. I'm not sure. But it's been a little while. Stocks continued to do very well. They came out with earnings 12 cents versus 3 cents. And on the symbol summary here, if we type it in pre-market, we will see the stock's up 3.5% today. So it's getting a positive reaction. Still got some work to do. I think a lot of this is already built in. That's why we had this big move. So I'm not surprised we beat. And in fact, I would have expected us to beat. LRN should have beaten, and they did. Didn't see the revenues, but I know bottom line they beat pretty handily. So we might just simply consolidate. Maybe even after the news is out, maybe we pull back one more time. But I like the chart, and this is a stock that I still think looks pretty good. Another company that, in fact, LRN reported yesterday, one that reported this morning was Brinkers, EAT. Stock doing really well and trying to make this breakout. They came in with a big loss, 88 cents, but the market was expecting a loss of $1.47. So they're starting to see at least improvement in their business. And this breakout above 32.5 would be bullish. Again, right now, pre-market 31.5, but watch that top, see if we can get that close above that area. After the bell today, we got Cisco reporting. All right, 3 you must see, and then we'll wrap this thing up. I'm going to start with AMD. AMD had a rough day yesterday, along with a lot of technology stocks. Keep this one on your radar, though. I wouldn't be surprised to see it turn at the 20-day. You've also got gap support down here at about 68, so that 68 to 73 range. And then ultimately, this big breakout occurred back down at around 60, although we pulled back, tested that, maybe 62. So it's still got downside, but I really like AMD. I mean, if you're longer term, I think this is a great looking stock. Short term, yeah, it could whipsaw you for sure because there's so many different levels it could turn at. But if we get a reversing candle on the 20-day, that would certainly be a good sign for me. Second is DLR. By the way, these are all 3 stocks that were among the biggest losers yesterday on the S&P 500. So we come up here, always got to beware a candle like that. First of all, check the volume out. Heavy volume, heaviest volume it had in a month. Reversal, black candle, off of an uptrend, and now we see the selling. People always ask, when do you sell? When's a good sell time? If I break out and I see a reversing candle like that, I sell. Don't take any chances. And then I'm looking maybe for a retest of this breakout level or the 20-day. Well, we went below, and I'd really like to see this reverse at 150. DLR, I think, needs to reverse at 150. Last stock I have is Mosaic MOS. And a reversing candle here. Be interesting to see if it can break back up above. That is a dark cloud cover candle. I would look for at least a lower low today to print at some point. And I wouldn't rule out the 20-day test. That would actually be a pretty good entry. AD line here, not very strong. All right, that is it for today. Appreciate everybody stopping by. I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. Everybody have a great day. Happy trading.